Here.
Ms. Hika?
Here.
Ms. Vargas?
Here.
Representing the Director of Finance, Ms. Longhead. Chairperson Rose.
Great, thank you very much. So good morning, everybody. We have a this is our annual favorite meeting where we get to review the financial statements, and can we start with the approval of the committee agenda?
I move to.
Do we have a motion, a second? Second, great. All in favor?
Aye.
Opposed? Abstentions? Great. The next issue is the report, the annual report of benefit payment modifications. It is a consent item. Is there anybody who desires that we remove that? Okay. Seeing nobody, then let's go on to item 4, which is the independent financial statement auditor reports.
Yes,
So Larry.
Mr. Chair, I'll roll this off here and then introduce the team. CalSTRS is required to have an audit of its financial statements annually, and management is first responsible for the preparation of our financial statements, and Crow LLP is the board's independent financial statement auditor, and they have completed their audit of the financial statements as of June 30th, 2018, and are here today to present the results to the committee. And to my left are Brenda Torres, partner with Crow, Jen Aris, who is our on-site manager, and Kevin Smith, who is also a partner. And I'd like to invite the team to present their results to the committee today. Item 4A, I might remind the committee, is an action item for their independent auditor's report for acceptance and adoption of the resolution that is on ARM 100. Turn their time now over to Crow.
Thank you, Larry. And good morning, Mr. Chair and members of the Audits and Risk Management Committee. I am so thrilled to hear that this is your favorite meeting or best meeting of the year. So wanted to make sure I tuned into that this morning. You know, this is why you hire Crow. You know, we are here to present to you the results of the work that we conducted during the last fiscal year. I think that when we get to the end of the presentation, you're going to be quite pleased with what you hear. I do want to take the opportunity to thank a number of members of management who are currently in the room today, as well as those that are probably watching this live streamed. Impeccable job on their presentation and responsiveness to our request. Certainly, it's a very robust audit process. We're really doing a continuous audit. We're already working on next year. So with that being said, I just want to thank them for their hard work. The agenda is going to be typical to what you've seen in previous years. I'm going to ask Jen to introduce herself in a minute since she's relatively new to all of you. We're going to go through the independent auditor's report, required communications to those charged with governance, which is all of you, and then I'm going to share the report on internal control. Like always, happy to take questions as we go throughout our presentation, so please don't hesitate to ask. You're very familiar with Kevin and myself. You know, we've been on this engagement since the inception of our relationship working with CalSTRS. But with that, Jen, why don't you take a brief minute to introduce yourself and your history with Crow and role in the engagement.
Thank you. Yeah, good morning to the committee. I'm Jen Aris. I'm a managing director with Crow. I'm in our public sector services practice. Spend my time working on governmental entities as well as have audited benefit plans and pension plans for about the past 16 years. I'm located in our Sacramento office, so just right across the river from you. Work closely with Brenda and Kevin on the engagement and am here on site virtually for the entire time. Given my proximity. So work closely in working with management and with supervising our team performing the substantive audit procedures.
Good morning. It's my pleasure to talk about the independent auditor's report, or the opinion, which, as Brenda said, is ultimately why you guys engage us. Out of the 90 some odd pages of the annual financial report, these 2 pages are what Crow owns. versus management's responsibility. We'll walk through a variety of elements that I think it's important to understand within the opinion. But to cut to the chase and look at the fourth bullet, kind of like reading the last page of the book before you start the book, you did receive an unmodified opinion. That's consistent with years past. But the positive story that Brenda wants to share, I think, will really come out in the letter charge to those with governance as well as the internal control report. But we will talk about management's responsibility, auditor's responsibility, what that means as far as professional standards goes, ultimately our opinion, as well as two emphasis of matters paragraphs. So first and foremost, as you see on ARM page 18, management is ultimately responsible for the fair presentations of the financial statements. They're also responsible for the design and implementation of internal control over the financial reporting. So the audit does not relieve them of their responsibility as it relates to the financial statements. We too have a responsibility, and those responsibilities are grounded really within two frameworks: generally accepted accounting principles, as well as government auditing standards. So generally accepted auditing standards published by the AICPA, government auditing standards published by the GAO. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free from material misstatement. We focus on this reasonable assurance for a couple reasons. One, it really kind of contemplates two central notions that I think it's important as board members to understand. We look at the financial statements from a materiality standpoint. We're not auditing to the penny. And we also rely heavily upon sampling techniques. If we were to look at every transaction, we would have the same number of staff as you have, and we'd set up on a stool behind them and watch them as they post each transaction throughout the year. So we really have to look at it from a materiality standpoint as well as a sampling. We focus on account amounts and disclosures within the financial statements, and we apply auditor judgment in understanding the risk of material misstatement. That can really be focused on routine transactions such as your benefit payments, or even more significantly, anywhere where management has the ability to have significant estimates. That primarily relates both to the actuarially accrued liability or the total pension liability, as well as the fair value of certain investments that aren't readily traded on a market. We consider internal control. Unlike a PCOB report, we are not opining upon your internal control, but we do consider it and we test it, both design and operating effectiveness, and to understand overall what the impact it has on risk of significant misstatement. We also spend considerable time talking about the appropriateness of the accounting policies and the reasonableness of significant accounting estimates. And Jen will talk about those in the letter charge, or the letter to those charged with governance. Again, I stole my thunder on the first slide. Our opinion is unmodified. We're able to issue a modified opinion, which is a qualified or adverse, or an unmodified opinion. And you receive the highest level of assurance that we can provide. And really it means two things. The financial statements are prepared in accordance with generally accepted accounting principles, which would be those published by the GASB or the Governmental Accounting Standards Board, as well as that those amounts are supported by the underlying books and records of the system. We do include two emphasis paragraphs. Emphasis paragraphs are of such a nature that it's really to tell the reader, embedded within the financial statements are a couple things that we want you to pay particular attention to. Now, probably the most important part of this paragraph is the very last sentence, that it's our opinion is not modified with respect to this matter. But the first emphasis of matter is really talking about the net pension liabilities and the non-employer contributing entity. And it's not so much focused on, we're saying that the 71% funding percentage is bad and that it should be this or that. It's really talking about how much it depends upon management's estimates, management's and the boards. Those include their actuarial assumptions, including the investment rate of return of 7.1, the CPI of 2.75, the wage growth. Each of those having a significant impact upon ultimately what is recorded as the total pension liability. So there's enough of an estimate there that we're calling the reader's attention to that fact. Our second emphasis of matter, again, is on the fair value of investments, and it's really focused on what you could see in the financial statements as level 3 or NAV investments, but these are investments that are not actively traded on a market or have distinct observable inputs. So it's an area where there is significant estimation made by both general partners and reviewed by management and approved by management. But this is an area where, again, a significant amount of estimates over the carrying value or the fair value of the investments as of June 30th. It's not an indication of risk, it's an indication of the significance of the assumptions embedded within determining the fair value. Jen?
Thank you, Kevin. The first part of our required communications to those charged with governance actually relates back to the auditor's responsibility, and Kevin actually just went through that with you. It's reiterated in our audit opinion. The next item that we wanted to go through in our letter to you, starting on ARM page 102, is just a refresh on the plan scope and timing of the audit. And so I know that Crow met with you back in February to discuss our audit plan, and the purpose here is really just to circle back on that and confirm to you our approach for the audit. We do perform a risk-based audit, and we critically evaluate any significant risks of material misstatement that may exist in the financial statements. As Kevin mentioned, we do take a look at internal controls, not for the purpose necessarily of issuing an opinion on internal controls, but really to help us plan our audit, as well as if any matters were to come to our attention through the audit process, we would be reporting those to you as we have in the past. And we'll talk about that a bit more in a moment. In assessing materiality levels, we do look both at qualitative and quantitative assessments and coming to those conclusions. And we work closely with Larry and the internal audit function to understand the role that they play and how that may assist us in the audit or other areas of consideration that we may have from an audit process. And then lastly, it's important for us to have an open line of communication with those charged with governance. So any matters that may be of significant concern to you in your role, any insight that you can provide from a risk or strategy standpoint is also really important to us in that audit process. Some of the key considerations that we looked at in performing the current year audit, first of all, looking back at the prior deficiencies that we had identified and looking for remediation of those items. And I think you'll see as we move a bit further along in the presentation that there was remediation to items that had been identified in prior years. So something, really to be proud of as an organization, that those comments were addressed, and, we were able to see the results of the significant effort put in place by management and the team. So definitely something to be proud of there. As Kevin mentioned, we do take a significant look at any estimates involved in the audit process, and so we've listed here for you some of those that we pay most attention to, that are most critical to the financial reporting process. The existence and valuation of the investment portfolio is something that we spend a significant amount of our audit time on, perform a lot of control testing and substantive procedures related to that. We also spend a significant amount of time looking at the actuarial assumptions, both for the total pension liability as well as the total OPEB liability. Enterprise risk management, evaluating tone at the top, and other entity level controls is also a significant portion of the audit. We have spent time understanding the implementation of the new pension solution and the timing of that as to when it will impact the organization on a go-forward basis, but did not perform any testing procedures in the 2017-18 audit because no financially significant information is being processed through that system at this time. So therefore, no audit procedures were performed. And then this year, there was a new accounting standard that was implemented that you have some more information in the letter regarding. GASB 75 required the recognition of a liability related to other post-employment benefits that members of CalSTRS are receiving as part of their employment here. Continuing on, we do take a look at the qualitative assessment of significant accounting practices. We take a look at the consistency of the application of those practices in the financial statements. We're also looking for any errors that may have occurred that would lead to a corrected or uncorrected misstatement. And we're happy to report to you that there were no audit adjustments this year. So that, again, is very good news and certainly speaks to the reliability of information that you receive regarding the financial statements on an interim basis throughout the year. And then looking at the financial reporting process, we take a look at the any unusual transactions that may impact financial reporting. Also take a look at any judgments that have been made in presenting financial statement information, and any sort of selective correction of items or inclusion of information in the financial statements. Lastly, we have for you other communications. We do read through the MD&A that's prepared by management and provide feedback on that information. We also look at it for consistency with the information in the audited financial statements. We've listed for you here the other schedules that we look at as part of the audit process. And then toward the end of the year, we will be looking at the comprehensive, the CAFR that's prepared for the organization as well, the comprehensive annual financial report. And then lastly, if we were to have any difficulties in performing the audit, any disagreements with management, be aware of any other consultations with other accountants or anything else of significance that we felt necessary to bring to the committee, we would do that. We have provided our report on internal controls that we'll go over in just a moment, and we have provided a management recommendation letter that we will also review in addition to our engagement letter, but we have no other matters to report to the committee.
And with that, I'm going to close as it relates to the independent auditor's report on internal control over financial reporting. As Kevin and Jen both iterated, and I'll repeat it for you, it's our responsibility to make sure we understand the environment and assess the internal controls, but we are not issuing an opinion on the internal controls. So therefore, our consideration is for a limited purpose. What I can tell you is based on the work that we performed, both over the internal controls as well as throughout our substantive testing, we have no significant deficiencies or material weaknesses to report to all of you. As we identify deficiencies in internal control, we look at those individually and in the aggregate. And so none of those deficiencies rise to the level that need to be reported to you as those charged with governance. What I would like to say is kind of state maybe the obvious to some of you, but I think it's important that you think about these things. So during this fiscal year, if you think about what the organization is undergoing, so they continue to expend a ton of resources with the implementation of the new pension solution. There were vacancies during the year in the investments branch. You had an unanticipated or maybe unexpected retirement of the former CFO, Robin Madsen. You elected an interim CFO and Lucy Arbuckle and her team to take over and were in those positions until you hired Julie Underwood, who joined you in July. So I say collectively, when you look at the dynamics that were in play during this past fiscal year, and you consider that there are no significant deficiencies and material weaknesses, I would just say congratulations to the organization and to all of you, because I just think that is absolutely outstanding. It really speaks to the tone at the top, every level of executive leadership. I will tell you that when we ask questions, we first seek to understand before placing our judgments, and every person we talk to in the organization is very willing to answer our questions, wants to take everything that we bring up very, very seriously and make sure that we get the information that we need in order to make an appropriate assessment. So with that, I would just tell you, in my professional opinion, you should feel really good about those results, and congratulations again to management. And with that, we'll take questions.
Can I just say that is great news to hear. It's great news to hear, first of all, that the material weaknesses and the significant deficiencies have been addressed, because that was a lot of work. And that was something that was, an area of significant concern a few years ago. It's also great to hear that you have confidence in our staff and had great cooperation and help from the staff. And I think you're absolutely right. This was a year of transition where there were a lot of changes. And the fact that the audit came out the way it did, and that you can report to us in such a positive way is wonderful to hear, and really something that the staff should be congratulated on, everybody. So thank you, everybody who has assisted in this effort. So, Bob, Larry, anything to add?
Yep.
I figured there would be.
So as the board may recall, this is the first year that in the internal control report, we've not had a material weakness or significant deficiency for a number of years, or a combination of those items for a number of years. And so this was the first year in some time that we've had neither of those. And it wasn't like a switch. It wasn't just, oh, it all happened just this year. It's taken a lot of work over a number of years by a lot of people. And work was done on behalf of the auditors, who have become more familiar with CalSTRS and its operations and gain a level of comfort and understanding. It's been work by the auditors to work with CalSTRS to help identify issues within the organization that would cause uncertainty over member data, let's say, which would lead to a material weakness or a significant deficiency. And then there was a lot of work just within staff itself to say, okay, we need to figure out what this is and what it is. And it wasn't just staff level, it went all the way right up to even Cassandra got involved, I don't know if you recall, to help trace through an item, let's say. So a piece of data comes in, where does it go? Where does it wind up? How does that wind up on the financial statements? And to be honest, when an organization has a known weakness, but understands it really well, to an auditor's eye, well, at least to this auditor's eye, that provides me some level of assurance. I feel better if an organization at least knows where the problems are. And so there's been a real development within CalSTRS to not only fix the things that have been wrong, but a real effort to try to understand what things are wrong. And that in itself has made a significant progress towards where we are today. So it's not just 1 year, it's not just throwing a switch. It's a multi-year effort, year after year after year. And so it's a pretty, for an auditor, it's a pretty great day. Thank you.
Larry?
Yeah, just one thing. We heard a couple of mentions today about the pension solution, that it's not really I think we mentioned it wasn't really a financially significant system as of yet, but it will be here soon. And so I just wanted to let the committee know that we're already having preliminary conversations with Crow about the pension solution and its functionality and areas of emphasis for future audit work that they'll be performing. And we'll be meeting with them as a management team at the first part of the year. We have a meeting scheduled where we're going to dig down into a little more detail for them and start making sure that they have an understanding of the system and the flow of financial information, so that when it is a financially significant system relied upon for preparation of our financial statements, that they're ready to go and that they understand the system. And so I just want to let the committee know we're working on that. Just as a reminder, 4A was an action item for acceptance of the report, as well as approval of the resolution on ARM 100.
Before we get to that, I want to make sure that there are no other questions. I don't see any from the committee. I have one question. Now that we've got the significant deficiencies and material weaknesses out of the way, which is where we focus most of our attention, I actually have a question about the two emphasis of matters. And I know that you said that your opinion is not in any way affected by them. And one has to do with actuarial assumptions, and the other has to do with the valuation of investments that aren't publicly traded. And I think, if I'm not mistaken, that we've heard this from you each year. Is that correct? I mean, this is each year we hear the same thing.
Correct.
Okay. And do you also tell all of your other public pension clients the same thing, because they're subject to the same kinds of risks?
Yes.
Okay, so it's important for us to know this. There's really, it's not a material risk in terms of your conclusions, and there's really not that much we can do about it, because it's just the nature of of the just reality. Is that right? I mean, you're not suggesting that we have to do something to address this?
Yeah, I'll take that. No, I don't think this is really to highlight for, not only for you, but all users of the financial statements. So you just have an opportunity to understand that when you're taking into account management's judgment, where do you find management's judgment in the financial reporting? And it's really embedded in those numbers. So I think it's the materiality, the significance of those estimates. They're driving very large balances throughout the financial reporting. So it's just to highlight for all of you and the users of financial statements so you understand the significance of that. If we had any concerns relative to the estimates that were used by management, we would be talking to you about that right now. And we would highlight for you if we had concerns over the assumptions, or if we that relate to the total pension liability, or if we felt like there was some indiscretion, it was related to how the fair value of the alternative investments were derived. And what I can assure you is within our approach and the sampling techniques that are supported by the standards, we did not find anything in those areas.
Okay, great, thank you. I don't see any other questions, so would somebody like to make a motion?
Yeah, I'll move approval of item 4A. Second.
Okay. Great, we have a motion and a second. All in favor?
Aye.
Opposed? Abstentions? Great. Well, thank you very much. Great news, and appreciate all of your work and the partnership that we have developed. I think it's been extremely productive for the organization and for this committee as well. So thank you.
Thank you, Mr. Chair.
Okay. So the next item is item 5, the 2018 management letter. Larry and Julie.
So I think this was alluded to just a second ago, that in the connection with the audit of the 2018 financial statements, the auditor may identify deficiencies in internal control. And if the deficiency does not rise to a material or a significant finding, then they, those are the types of issues that they're required to report to the board. These deficiencies, they report to management through the use of a management letter. And although they're not required to, according to their standards, report it to the board, for the sake of promoting transparency, we choose to do so. And it allows the board to see the types of issues that we continue to work with and that Crow did identify during the course of their audit. And basically, there are 3 issues that are identified in this report. The first one is an ongoing issue that we've been dealing with, as was mentioned, for the last several years with regards to active member data and the completeness of member data. The second one is on unfunded commitments and the reporting of those. And the third is the schedule of proportionate share and the level of precision within that schedule. The issue of active member data is a deficiency that we have had a lot of emphasis on in the last few years. It's an important issue, and as Ed stated in the letter, management has made significant progress in understanding and improving this deficiency. But this year there was a new emphasis, which is on the type of data that is not reported to CalSTRS. And so that gives a little bit of a different spin to it this year for us to look at and to think about how we can fully address that issue. And management has prepared a response to it, and Crow reviewed that response, and we're continuing to further enhance our use of data analytics, our enhancements to the risk and control matrix that we use, and continuing our internal audits that focus on member data and internal controls over member data as outlined in our plan. And management agreed with those recommendations, and we will continue working on that and provide periodic report to the committee of our progress. I'll pause now and see if you have any questions on that particular item.
Yes, Lynn.
Thank you. And congratulations again on such great work, and really appreciate everything that the auditor had to say. I want to congratulate the staff. But I did have a question on the data analytics. And is this something that Pension Solutions will help to strengthen as you move forward with the implementation?
Yes, there will be a tremendous benefit with regards to having a data warehouse that we will be able to analyze data. And then not only that, with the new file format that we're considering for the pension solution, it will have more complete data for us to be able to review and understand what's not reported as creditable compensation.
Okay, so the work that you're planning to do this year and until pension solution is fully implemented, is this kind of interim steps to work on the data until you finally implement pension solution?
We're able to obtain a lot of data from our existing systems, but it doesn't have, what's only reported is creditable compensation. And so if it's not creditable compensation, it's not reported to us as an organization. And so the pension solution will give us a complete picture of all compensation, and then we can analyze that which is creditable and which is not.
Okay, all right, thank you.
Mm-hmm. Okay, the next two items, Julie Underwood has joined us here to review those with the committee.
Thank you. So for the unfunded commitments, just to give you some background on what happened here, a decision was made to not track and to not report certain unfunded commitments related to co-investment positions. And so when that decision was made, our internal controls in place were not sufficient enough to rise that decision to senior management's attention for a final analysis. And so although that decision was immaterial to our financial statements, we will still be enhancing our internal controls to ensure that future decisions about tracking and reporting related to unfunded commitments will rise to senior management's attention so that we can analyze it and make a final decision for reporting to ensure that this disclosure remains complete and accurate. So any questions on that?
And I think you're working closely with the investment office on this issue as well.
Yes.
Yep.
Okay, so moving on to the schedule of proportionate share.
Looks like Bob had something.
Yeah, just a real quick thing. Hi, Julie.
Hi.
And Harry.
So just super quick, with the unfunded commitments, were those discretionary and non-discretionary?
It was both.
Okay, it was a mix of both?
It was a mix.
Can you
Okay.
explain what you mean by that?
You want me to explain?
Well, somebody, you said discretionary and non-discretionary. What's the difference in?
The extent. Never gonna address that, to which there's discretion.
I know that. Thank you, Bob.
For the record, Deborah Smith, Chief Operating Investment Officer. So the discretionary is that we have the ability to cancel or redirect investment commitments.
At our option.
Correct.
Okay.
Non-discretionary means we're legally obligated for that commitment. So Julie's right. There was a decision made for both the non-discretionary and the discretionary. But we will be working on internal controls to enhance it. This is a manual process, and we're going to look for an automated solution to enhance this process.
And the goal is to rise to a higher level, the decision as to how to account for both the discretionary and the non-discretionary? Okay. And Harry has a question.
Yeah, thanks, Paul. So I'm just trying to understand the practical application or implications of this change. Will it affect decision-making process in any way, or slow things down? I'm trying to understand how, yeah, I'm trying to understand it a little bit better.
I certainly don't think it'll slow things down. It just didn't rise to senior management's attention. This particular decision was one decision that was made. And so we're just putting in an additional layer of approval at the higher levels to make sure that this doesn't happen again.
Sure. Okay. Thanks. Yeah.
In my opinion, this is a really small thing. Yeah.
Joy?
Yeah. Just.
Sorry, I'm going to ask the question even if Bob just said it's a really small thing.
Oh, no, sorry.
So I think I just wanted to clarify, this is purely internal in how we make decisions about how to account for these commitments as opposed to affecting negotiations with or our relationships with our external managers. Okay, thank you.
Yeah, the decision's already been made.
Yeah.
Yep, it's just
Okay.
reporting. Yeah.
Great. Thank you, thank you. So then,
Moving on to
continue.
the proportionate
Yes,
share.
thank you, Ju.
So when we prepare the financial statements, we prepare one proportionate share schedule for both the STRIP plan and the Medicare Premium Payment Program. And when we're reviewing that schedule, we only review it from the STRIP perspective. And in the STRIP, we include the state's contribution. That's the non-employer contributing entity piece. It's a very large contribution. And when we do our analysis, that large contribution is in there. And so when we strip that state contribution out to place it in the MPP program, we don't do a second analysis, which would, by stripping out that large contribution, give us a lower threshold to look at. And so we agree with Crow that we should be doing a second analysis of that MPP schedule before we place it in the financial statement. So we will be doing that on a go-forward basis, and we will also ensure that we are documenting our findings appropriately. Any questions on that?
No questions from the committee. Bob, do you have any comments on that? Okay. Great. Well, thank you then. I appreciate that. And this is not an action item, it's just informational. So moving on, then Larry, the internal audit plan progress report.
Yeah, this is required by our standards, and it provides the committee a progress report on the 2018 internal audit plan. And overall, we're making very good progress on completing the plan that was approved by the committee in November of 2017. And I've invited Mike Dutel, who's the supervising auditor over our employer audit program, and Cheryl Dietz, who's the supervising auditor over internal audits, to provide an overview to the committee.
Thank you, Larry. The employer audit team is on track to exceed its annual goal of 75 audits. As of September 30th, we completed 54 audits, which include 48 full scope audits plus 6 limit scope reviews. A listing of the completed audits can be found on ARM pages 118 and 119. Out of the 54 audits, 33 employers were found to have at least one systemic finding. A systemic finding and its impact is not limited to the sample population that received the payment. Instead, the finding most likely applied to all other members that received the payment. This is normally due to how an employer codes a payment to be reported to CalSTRS in its payroll reporting system. For example, a common systemic finding we found is when an employer incorrectly codes extra duty earnings as special compensation when it should be coded as a part-time assignment. The finding often results in a change in the employer's payroll reporting process for all members that received the miscoded payment. In total, we found 124 findings. The 3 common finding types we found were unreported post-retirement earnings, which was found in 1/3 of our audits, misreported special compensation, which was found in nearly 2/3 of our audits, and misreported unused sick leave, which was found in nearly 1/3 of our audits. To date, we issued 60 final reports and completed 22 draft reports, most of which I expect to be issued as final before the year end. Currently, 62 audits are in progress, which includes 15 limited scope reviews. The limited scope reviews are specifically focused on one-time payments and performed as desk audits. I'd be happy to answer any questions the committee may have. Thank you.
I don't see any questions. So thank you. Oh, I see you, Bob. Sorry.
Thanks, Mike. So those limited scopes.
Yes.
So the idea behind doing them was at a lower cost, basically desk audit. We can get a large chunk of what we would do on an audit because we're focusing on we're going for the low-hanging fruit.
Right.
Right. So can you just tell us, is it working? Does it seem as though that we are actually saving some resources and can redirect resources into other audit areas because we are catching the low-hanging fruit? Is it working?
Yes, that's true. Actually, for this current year, we started with the low-hanging fruit, which is the one-time payments. They're easily identified, which is special comp reported over $1,500 in 1 year. And also, we look at the high amounts of special compensation. For in that 1 month, it has to be over $50,000 and at least 35% of the annual special compensation reported. So that's a good impact. That's a good chunk of employers receiving, members receiving a one-time payment. And if you look on ARM 119, it shows we looked at 6, and it shows that 2 actually had no findings. But when we ran the risk assessment for these 2 employers, one of the no finding audits was a retroactive payment that was misreported as special comp, and the other one was an off salary schedule that was reported to the DB instead of the DBS plan. But in between where we ran the report and we're scheduled the audit, the employer backed out those payments and correctly reported. But other than that, it shows that we're catching these one-time payments that should be either not reported or reported to the DBS program.
So you're getting a high hit rate on these?
Yes.
Well, I think it's important on that table on 119 that those other ones that were identified were also what we call systemic issues, meaning that those findings apply to a large population of our membership. And so as it may be a one-time payment of a 2% bonus that was applied across the all employees within the district. And so it's a larger population. And I think it's also important to point out that these are active members that we're looking at. And so we're able to correct these problems, in advance and making sure that it doesn't result in an issue with regards to retirement calculation, so that it's accurate when they retire.
Yes.
Mm-hmm.
Last thing, so is the plan going forward to continue with look for some more low-hanging fruit?
Yes,
And expand this? Would we expect to see the proportion of desk audits versus full audits change over time?
Right. We will. And actually, we're going to expand it. We're going to look at not just one-time payments, but actually we're going to look at special compensation and also unused sick leave too.
So I have a question. So, so looking at ARM 118 and 119, the 48 full scope audits had 120 findings, and then how many of those 120 findings are the ones that we would be only specifically looking at in a limited scope audit? If you say the limited scope audits are focused on one-time payments, how many of those 120 findings, if you know, are one-time payments? Because I mean, it would make sense to say we do these full scope audits, there's a vast majority of the findings are in this one area, then let's just focus on that one area in limited scope audits. So is that what's happening?
Yes. What we did, we selected up to 25 employers that hit the one-time payment threshold, but we only looked at employers that maybe that weren't assessed as high risk for those. They may have been, but the ones that, out of these 120, a lot of them were one-time payment issues, but they also had unused sick leave and also post-retirement earnings, where these one-time payment audits most likely wouldn't. Actually, there was 2 audits that were started as one-time payments that we switched over to full scope because we found, when the auditor was looking at the records, they found other errors in there, so we just made it a full scope audit. But yeah.
When we say low-hanging fruit, the low-hanging fruit is the one-time payments, and we figure that out because these full scope audits,
yes,
for the most part, just find one-time payment problems.
Yes, that was very, very common for the special compensation.
We don't have the exact numbers, but on ARM 118, where you see that it says a systemic issue, there's a large number of those that had a systemic issue, and it's a high likelihood that most of those were some type of one-time payment or special compensation type of issues where it may have been a one-time that applied to everybody or to a smaller group of similarly situated individuals within the district. So example, maybe it applies to coaches per se or something like that. But most of these would be kind of the one time. We look through, on the full scope, we look through the full year of payments. On those limited scope reviews, based on the data analytics, we know exactly what month and what transaction and what pay period we're looking at though. And we just dial right in on it. It takes us less than a third of the time to conduct those reviews without travel cost as well. And so the benefit of that, I think, is tremendous.
I just wanted to confirm that basically we're learning from the results of the full scope audits.
Exactly. Yes.
Where to focus on limited scope audits to be more effective.
Correct.
Right.
Great.
Okay, so in addition to internal audits facilitating the financial statement audit that you just heard about, internal audits completed 2 audits which are summarized in ARM 122 and 125. The field services audit, the team identified a few opportunities to improve documentation, and management is working to improve and expand their current procedures. We also, internal audit, completed a contract compliance review of CalSTR's third-party administrator, FOIA, who performs record-keeping and administrative services for Pension 2. So in this audit, we identified instances in which the contract requirements were not aligning with actual practices. So currently, management is working with FOIA to relook at the contract and align it to the appropriate service levels. So as indicated in the agenda, we have 5 audits in progress, and I'm happy to state that we've completed 2 additional audits, so making it down to 3 in progress, and we're currently drafting those reports. These are enterprise risk management and internal controls over member data service retirement. So I'll pause here before I go on to see if you have any questions on those. Okay. So we facilitated the completion of 2 audits that were performed by KPMG. And KPMG is here today, and I'd like to introduce the team to the committee. We have Matthew Snyder, Principal, Justin Zavis, Director, and Sophia Vuzianis, Manager. Thanks. So KPMG performed an assessment of a new pension program allocation tool that is used in developing the financial statements, and that assessment is summarized at ARM 128. KPMG noted that the tool is working as intended and found a few opportunities to strengthen controls, with the most significant being around key person dependency. So management has agreed to train additional staff on this tool, which is very important. Just on the maintenance, there was only 1 person doing it, and so now they're training additional staff.
Cheryl, could you describe what the pension program allocation is? What is that?
Yeah. Let me help out for a second here. So we have different funds in our financial statement, and we manage the investment portfolio, and it's allocated across those other programs that are included in our financial statement. And so they use a methodology for estimating the allocation of those investment assets across the programs. And so it's important, we want to make sure that it's accurate and that the reasonableness of the allocation methodology and the completeness of it, so that it's done accurately for financial reporting purposes.
Thank you. Any other questions? Okay, so KPMG also performed a comprehensive review over the CalSTR's Master Custodian, State Street, and that's summarized at ARM 129. So we also have representatives from State Street in the audience that I'd like to introduce to the committee. So Jessica Donahue, Executive Vice President, Global Head of Performance and Analytics. Brenda Dolger-Shaken, Senior Vice President, Global Services. Travis Calabio, Vice President, Relationship Manager. Matt Swan, Vice President, Performance and Analytics. And Cameron Bull, Vice President, Fund Accounting. So our relationship with State Street is critical in supporting our investment operations. So we worked collaboratively with investment operations in developing a detailed audit scope, focusing on the State Street's internal controls over various areas such as performance monitoring, fund accounting, custody services, pricing, fund valuation, and new account setup. So although KPMG did identify some significant deficiencies over controls related to tolerance checks and change management, I want to make note that there are no significant issues on fund valuation or performance calculations. I believe this is because staff actively monitor this part of their workload, as part of their workload. And the investment office is working with State Street to ensure the improvement over controls and service levels.
If I could just add a little more context to that. You may notice that these items, while they are classified as significant items, State Street as our master custodian processes hundreds or thousands of transactions annually for us. And what we found here is that those that are kind of straight through processing and pricing it with regards to pricing, valuation, and accounting for them, were fine. These areas focused in kind of when there was changes that occurred, manual adjustments that occurred, or when we were asked them to reorganize, say, our aggregate of funds into particular portfolios. And so they're kind of the one-off transactions, if you will. And so for some of these transactions, there may be only approximately 150 or so per year. And so I'd just like to emphasize, though, that every transaction is important to us, of course, but they're a little different context for these types of items that are being processed. And when changes occur or manual adjustments occur, State Street has taken this very seriously, and have representatives here today if the committee would like to ask any questions. But they've already started working, diligently with management to implement controls. They've made changes already and developed some tools that they're using, and then have already started looking at how to improve these. And so along with the last audit of Voya and this audit of State Street, it's the first time in the last several years at least that we've actually gone out and gone on site to some of our third-party administrators and did audit work at their on-site locations. And so it was an opportunity for us to really dig down deep into what was happening, with these third-party administrators. And with regards to State Street, we're going to have discussed with them that we're going to be doing periodic audits and reviews. And while we will have KPMG go back in the spring of this year and verify that all of the corrective actions were implemented as outlined in the report, we'll be performing periodic audits of State Street as well, where we'll take a deeper dive into certain areas. And this one had a very broad scope, and I think it was a very comprehensive review, and appreciated the work that KPMG, but also appreciate the work that State Street and our investment folks are taking action on all of the items that were identified.
Great, thank you. I have a couple of members who want to speak. Nora?
I have a question. When you talk about the third-party administrators, how many different type of systems are out there? Is there databases, or the administrators, is it always the same, or is it there's different ways that people are collecting data? That's what I'm trying to better understand.
So for our investment activity, State Street is the primary master custodian.
Okay.
That all of our investments are accounted for within their records.
And then for our Pension 2 program, Voya is the record keeper for those transactions.
And then you have a cheat sheet with different colors on the form, green, yellow, orange. And I don't know if the little circles and all that thing, do they mean different things? I don't, I just want to better understand.
Yeah. So
I understand the colors, but is there a reason why something is a circle, a square, or is it just to be good?
We did the shapes on purpose because some people may not be able to see the colors correctly.
Got it.
So we did.
Yeah, so on ARM 122,
yes,
there's a rating scale that's outlined there. And so, for example, the circle or the green, the controls are adequate in addressing the risk and providing a reasonable level of assurance, but maybe there are some, and the procedures are documented and things like that and operating effectively. But we identified, a high level of compliance, but we found some opportunities to improve them. Whereas when you get to the diamond or the red one there, the controls are ineffective in addressing the risk, and perhaps even no process exists to manage the risk. And so those that were identified as the items of most significant is where the focus is on implementing new procedures and new controls and new tools to address it. And so we may see some where perhaps a control is in place, but maybe it's not documented. And so that would have a lower level of significance in our reporting, because it's there. It's just a matter of making sure that it's documented.
And there's somebody that follows up once you do the rating that so you do a rating and you figure out there's an issue that we have to address, and then there's going to be a follow-up at some point.
Correct.
Okay.
And so we discussed the ratings at what we call an exit conference. And so at the conclusion of the review, the auditor determines the rating, and then it's discussed with management and also with the client, and in this case, State Street. And we discuss those, have a discussion with them. And then with regards to follow-up, KPMG will follow up in the spring of 2019. State Street has outlined for us their responses and actions that they're going to take in order to address the deficiencies noted here. They said that in March of 2019, they will be done with implementing all of their corrective actions. And so after that, we'll have KPMG come back in and validate and ensure that new controls are in place and that they're operating as intended.
And then we get a report back.
And then, yes, and then we report periodically, twice a year. We report to the committee the status of these findings. And so you'll see as they're either in progress or completed.
Thank you.
And I also wanted to just make one other comment. So if there is a significant issue of red, we will, if it's gone beyond a year, we will bring that to your attention.
Thank you.
Jacqueline.
Some of my questions have been answered. I had similar questions about timeline, sort of what would be the follow-up. You said you'd be doing periodic kind of reviews of them. How will that be on the twice a year kind of, how frequent or periodic reviews that you'll be implementing?
We're working on with the investment audit office on that, and preliminary, we're thinking, like every other year or every 3 years.
Okay.
That we'll do that. And then also, I might want to note that part of our contract with them requires an annual internal audit on specific areas that they address with our investment office, and they focus on doing a review, and then they provide our investment audit office, the audit results. And so they have internal audits that are taking place on our account, and then we're going to incorporate the external audits as well. And so we'll have a different set of eyes on it too.
Okay. Thanks. One last question. Some of the issues that you have outlined in the chart that are being addressed, and there's sort of a timeline for them. Can you help me understand whether those, I know that we're looking at them specific to CalSTRS dealing with State Street, but are these sort of internal State Street controls that you thought were lacking that will now be sort of fixed for all of their clients? Sort of, are they business practices that would apply to State Street in all of its dealings, or are these somehow specific to CalSTRS? I know that we looked at it because this, you're looking at our specific dealings, but I'm just kind of curious. I'm trying to understand these specific controls.
I believe that probably in some cases they could be beneficial to the other clients, but it depends on if our requirements are specific to our account. And I'm not sure in which instances these would be specific to our accounts.
Okay, so possibly.
I believe, if you want, State Street might be able to answer that if they want to come up and answer that question.